As we approach another US election, I'm led to reflect on the age-old American ethos, the American dream. At the heart of the American dream is the idea that anyone can start a business and they can change the world through ingenuity, hard work, and investment. And the story of the first powered manned flight is case in point. So in October 1903, an aircraft launched from a houseboat on a river just south of Washington, D.C. The US Department of War had backed this historic effort with $1.7 million of today's money after successful tests involving a smaller unmanned prototype. Now, the craft immediately crashed into the water. An attempt weeks later by its inventor ended in a similar fate. Instead, it was two bicycle salesmen, Orville and Wilbur Wright, who made history with the Wright Flyer that same year. It had cost the brothers $35,000, about 50 times less than the government had spent on the other project. The company the brothers subsequently founded survives within the aeronautical component maker Curtiss Wright and has links to the defense giant Lockheed Martin. But why am I telling you this? Because when everything feels noisy, when interest rates, Fed cuts, inflation, and the US election are driving the narrative, it is very easy to lose sight of the simple fact. Ideas and progress drive growth. In 1952, the most hotly contested issue of the US election was the Korean War. That was at the same time as IBM introduced its first scientific computer. Which do you think was more important for long-term shareholder returns? In 1976, what mattered most? Was it the fallout of the Watergate scandal, or was it the founding of Apple? Ideas and progress drive growth. Now, the Wright brothers are part of a long list of curious, ambitious American pioneers who have created huge value. Some were born in the US, others were immigrants attracted by its immense advantages. At the end of 2023, 62 of the world's 100 most valuable listed companies were US-based. If we include Canada's Shopify, a platform for entrepreneurship, that brings North America's total to 63. The US is even more dominant in private companies, in young companies, many of which are private. And we continue to believe that the US will remain the best place to find and invest in exceptional growth in both public and private markets. And the reasons are manifold, and we believe they will continue to exist. The US has some of the best academic institutions in the world, and a strong talent pool which is supplemented by immigration. It has a broad and deep venture capital system that supercharges startup growth by providing funds alongside technical and managerial expertise. It has a strong intellectual capital protection and a business-friendly environment. And finally, it has an unrivaled culture of optimism, ambition, and a willingness to accept failure. But why focus on exceptional growth businesses? Well, first we need to flesh out what an exceptional growth business is. Now, conventional wisdom suggests that a company's growth rate will revert to the mean in time. Exceptional growth is about growing faster for longer than people expect and at higher rates of return. And we can see that here with the two companies in the graphs on the slides. So here's Amazon, which over the past 20 or so years has delivered an average revenue growth rate of more than 20%. In the other graph, we can see NVIDIA. Now, NVIDIA's had a much more cyclical revenue growth over that time period, but this is a 30-year old company that has delivered an acceleration in growth over the past few years. But why does this matter? Because continued exceptional growth is unexpected growth, and unexpected growth translates into upside, and thus a return for our clients. Because asymmetry drives everything in equities. The total wealth created by all listed US common stocks from 1926 to 2016 was $35 trillion. Half of that was generated by just 90 companies, 0.4% of all US stocks. Exceptional growth businesses are the drivers of returns. And finally, companies that grow the most perform the best. The companies with the fastest sales growth and EPS growth over 5-year periods deliver the largest total return. Fundamentals are reflected in share prices in the long run. Now, there are several characteristics that we look for in exceptional growth businesses. Distinctive cultures, large and often expanding market opportunities, and sustainable competitive advantages. But there are also a couple of other characteristics that really matter. One is resilience, the other is adaptability. Resilience, which allows you to navigate the short term, and adaptability to navigate the long term, which allows a company to unlock its growth potential. Of course, we look to invest over long periods of time, on average 5 to 10 years. But companies have to make it through the short term in order to get to that long run opportunity. Now, navigating the short term means surviving macro and/or, that's gone too far. There we go. Navigating the short term means navigating macro or economic uncertainty. And that requires 3 things: financial strength, an ability to transition to self-sustainability, or to ensure that financial markets remain open to them. It also needs long-term supportive shareholders who can provide capital support and a more stable shareholder register. And finally, these companies need a clear vision, an understanding of what they are trying to achieve, and ensuring that they keep that vision in mind when they need to make those shorter-term choices. Navigating the short term also means facing off against competitive pressures. Companies must ensure clear differentiation, whether in product or go-to-market, ensuring a company's edge, its advantage over the competition, can grow stronger over time. Now, navigating the long term is all about adaptability. It's retaining fitness regardless of the environment. Now, a study by management consultancy McKinsey in 1999 showed that the 30 most successful companies' business strategies were all about adaptability, balancing what they named the short jumps, the jumps you make where you know precisely where you're going to land, with the long jumps, the jumps you make where you know the direction that you're heading in, but you don't know precisely where you will land. And McKinsey called this framework the 3 horizons of growth. And you can see it here in visual form. Horizon 1 represents the core of a business. This is the part of the business which presently, and the emphasis here is on the word presently, delivers the greatest amount of free cash flow or profitability. Growth here is about attending to that existing business, improving its performance so as to maximize long-term value. Let's take an example. Language learning app, Duolingo. For Duolingo, Horizon 1 is the addition of new languages into that core language learning app, which ultimately helps them to broaden out their potential user base. Horizon 2 encompasses emerging opportunities which leverage existing opportunities. These are the medium jumps. They require more effort than Horizon 1, and this usually comes in the form of time or investments. Bringing back our friend Duolingo, this would be the inclusion of artificial intelligence into that core language learning app, which has enabled the company to create a new subscription tier, which is both higher priced and contains additional features. And finally, we have Horizon 3. These are the ideas for businesses that will exist down the road. These are the long jumps. This is planting the seeds for businesses that don't actually exist yet. For Duolingo, this is the inclusion of maths and music into that core language learning app, neither of which are significant contributors to revenue today, but have the potential to be so in the future. Now, the most intriguing thing about the McKinsey study is that the great growth businesses have investments and strategies which span all three of these horizons, whereas the average performing growth business tends to focus on Horizon 1. And this makes sense. Short jumps are just more comfortable. They are less risky, and they pay off in a shorter period of time. But if you only ever make the same size jump, you lose the ability to flex the size of your jump. In a nutshell, you lose your ability to adapt, a crucial component for any long-term investment. So whilst the broader market is focusing all of its energy and attention on the inflation, interest rate cuts, and the US election, we're also spending time thinking about the long-term drivers of change and how companies are adapting to meet them. So Wright's law observes that the production of volume of an item increases, its costs will fall, and quality will improve more quickly as the industry learns to improve its processes. Look at the price declines we've seen in the production of electric vehicles or battery costs, which have fallen by 2/3 over the past decade, or solar prices, which have fallen by close to 90% over the past decade. Now, these changes have really broad implications for things like the cost of compute, the energy transition, and our progress towards a cleaner world. Now, I could not discuss change without touching on artificial intelligence. The AI paradigm shift remains early. We've seen plenty of progress at the infrastructure layer, but the broader implications of the adoption of this technology are really just beginning. There is plenty of discussion as to the potential cost savings of AI, but what about the Jevons paradox? The paradox suggests that an increase in efficiency will lead to an increase in consumption. We can consume the same amount for less money, but instead we choose to consume more. And we've seen this pattern before with energy consumption, with the release of LED light bulbs, and with mobile internet data, where in both cases, as the cost has declined, society has chosen to consume more of it. Now, the deployment of AI systems at or around their current capabilities could have a meaningful impact on the global economy. There is almost unlimited demand for intelligence, and the pace of deployment will likely only be limited by the cost of supply. In our long-term framework, we must also, therefore, be open to the possibility of radical change and be prepared to change our minds in response. So the way we are thinking about the AI value chain is under these three broad areas: the hardware layer, the infrastructure, shall we say. These are the chip manufacturers, the companies that help design those chips, but also the providers of the necessary energy and cooling to be able to deliver on these areas. The software infrastructure layer, so that includes the models, that includes the cloud compute providers, and that also includes the data players who are helping to clean up that data to enable inferencing and training to be done on it. And finally, we have that app layer. And the diffusion of artificial intelligence varies greatly across these different layers. Everyone is focused on NVIDIA and the hardware layer, and that is important. But there's lots of change happening in that software layer too. And radical change doesn't just have to come from existing businesses. We can see here, as an example, a company like Meta. And we can see changes that are happening in the messaging services of someone like Meta. Their Messenger, their Instagram, in WhatsApp. They're deploying AI tools to enable businesses to respond to customers through those click-to-message ads. And then we have the application layer, which remains relatively untouched. but where some of the great investments of the future could emerge. Now, we have yet to determine the limits of artificial intelligence or how quickly it will continue to improve. But what we do know is that the applications and the impacts will get more dramatic the longer we stay on the current trajectory of progress. Beyond AI, what about the changes that are happening more broadly within American culture? Sleep, or lack of it, is becoming a serious health problem in the US. Nature is being viewed much more as a scarce resource, and people are returning to the great outdoors. And the turbulence of COVID and broader supply chains is forcing businesses and individuals to desire more control and resilience. Whether that be in their understanding, being conscious consumers of the food that they're eating or the companies that they're interacting with, or could it be that more people will be looking for energy independence over the next decade? And with battery prices continuing to fall, what has been a niche product could make a breakout. But navigating change is not an easy task. Change does not move at an even pace. We go through periods of relative stability and then periods of really rapid change. And change also gets more potent over time, reflecting the exponentially increasing number of ways technology can combine to produce goods and services. And that is why studying and understanding the people and culture at the heart of the American dream is so important for long-term growth investors. Orville and Wilbur Wright succeeded where others had failed because of their innovative research techniques, skill, and determination. And there is direct lineage from other original American dreamers to those changing our world today within the US Growth Trust. From the Wright brothers to Keller Ronaldo Clifton, chief executive and co-founder of Zipline, whose autonomous drones deliver everything from medical supplies to Walmart orders. From Leroy Grumman of Grumman Corporation, which made the Apollo mission's lunar modules, to Elon Musk's SpaceX, making the next version of the Artemis mission. From Robert Noyce, who invented the silicon microchip at Fairchild Semiconductor and co-founded Intel, to Jensen Huang, whose artificial intelligence superchips are driving many of today's software and scientific advances. From Wall Street banking titan John Pierpont Morgan and Visa founder Dee Hock, to John and Patrick Collinson, co-founders of the digital payments company Stripe. From venture capitalist Bob Swanson and biochemist Dr. Herbert Boyer, founders of the groundbreaking biotechnology firm Genentech, to Stefan Bancel, co-founder and CEO of mRNA vaccine manufacturer Moderna. And from telephone inventor Alexander Graham Bell, whose Bell Telephone Company became the foundation of AT&T, to Meta's Mark Zuckerberg, whose Facebook, Instagram, WhatsApp, and Messenger apps connect nearly 4 billion people. The pursuit of the American dream built the United States, and it continues to drive progress today. For example, Duolingo is pioneering the gamification of language learning with its accessible to everyone language learning platform. Alnylam Pharmaceuticals is tackling debilitating diseases by developing drugs that silence faulty genes. And Lineage Logistics is improving the frozen food supply chain, reducing waste and improving energy efficiency. And Roblox is entertaining, connecting, and educating millions of people via its online video game platform. Investing in America and the American dream involves looking forward. Sure, you can buy a cheap S&P 500 tracker fund and get broad exposure to the US and some of its big names. And that approach can play an important role in some people's portfolios. But a tracker may not give you access to some of the most innovative companies of today, like Duolingo, Alnylam, or Roblox. And it certainly won't allow you access to exceptional private growth companies like SpaceX, Zipline, and Stripe. We seek out the very best of these exceptional growth companies for our portfolio. And being a trust means we're free to back them, whether they trade on public markets or not. And shareholders can get access to these private companies for a fraction of the cost of traditional private equity. In just 4 generations, we've gone from having an aircraft barely capable of flying more than 850 feet to companies making autonomous drones carrying out 10-mile grocery deliveries and landing self-landing rockets. Of course, the macro environment and short-term questions can change the rate at which companies deliver on their long-run opportunities. Navigating storms is part of the process of driving change. But the companies the US Growth Trust invests in give flight to bold ideas and can generate huge value over time. That is the American dream made real. Thank you.
Thank you very much, Kirsty. That was absolutely fascinating. And with 2 teenage children myself, I'm certainly familiar with both Duolingo and Roblox. Although the role Duolingo played in my son's GCSE revision, I'm not sure I would quite keep up with that. Open the floor to questions. Anybody who's got a question for Kirsty? Yep, there's a gentleman at the back there.
I've read from, in several cases, about people saying we're on the verge of recession. The world is on the verge of recession. Somebody I was reading about yesterday said we're reaching another 1926 position. And as a second question, I'd like to ask you, who do you think would provide the best US growth, Harris or Trump?
You knew you were going to get asked that.
Yeah, I knew I was going to get that one. Well, yeah. So I think in terms of the first one, I think that it's very hard to tell at the moment. The economic data is being quite mixed around whether we're heading into recessionary environment or not. And obviously the most recent number in the US on jobs and the unemployment rate was actually very positive to suggest that the Fed maybe is cutting into a softer landing. But it is quite difficult to tell these things. What we can see from our businesses is that the fundamentals of the companies that we invest in are actually still very strong. And despite some weakening within the consumer, which is being called out by companies like Amazon, for example, many of the other consumer goods companies that we invest in have seen very strong results. So I think there's a danger sometimes in the US of assuming that the American consumer is a sort of singular entity. You know, it's a very big country with lots of different individuals within it as well. So I think the long run opportunity for the companies that we're investing in is those structural changes that I talked about earlier. And yes, the recession or a recessionary environment can probably affect the rate at which they achieve those opportunities. But as long as they have the necessary resilience and adaptability, we still believe in backing them. In terms of the election, so I've been running some numbers because I was interested to see what the sort of returns look like over the past sort of 6 decades or so are in an election year. So the average return for the S&P 500 over the past 6 decades, the average annual return is 8%. For an election year, the average is 9%. The average return after a Republican president is elected is 5%, and after a Democrat president is elected, it's 11%. Now, these numbers are greatly distorted by the fact that there are different events that happen. So when George W. Bush was elected, that was direct. He got the dot-com boom almost completely, straight afterwards, which obviously didn't help his numbers. And Joe Biden benefited massively by the opening up after COVID. So I think the reality is that, the index is not a direct replica of the economy. It only accounts for large public businesses. It doesn't account for unlisted businesses. It often doesn't account for those smaller companies, and it certainly doesn't account for government spending. There's also the fact that a chunk of the index in revenue does not come from the US. So for the S&P 500 as a whole, about 40% of its revenue is from international markets. So even if we assume that the president influences the economy completely, which I think is debatable in itself, it's not the singular factor that drives markets going forward. So what really does matter is that innovation and entrepreneurship, which I tried to highlight during my presentation. I think what I would say is that we would probably expect that, a Trump victory would probably lead to tax cuts, or maybe at least a constant level of taxation for companies. A Harris presidency would probably see those tax rates increased. Democratic candidates have a tendency to go after drug pricing in the US. That tends to be something that they tend to focus on. But I think what really matters is what's changing today, and which companies have the opportunity to make those outsized returns in the future, regardless of who's in power. Using the sort of pattern that I used earlier, ultimately, if we look back in 20 years, I don't think the discussion is going to be whether Harris or Trump won the election. It's probably going to be much more to do with who put in place the infrastructure necessary to be on board with that AI paradigm shift that potentially is to be coming.
And picking up one of your earlier slides, if you're looking at the third horizon, then that's through several presidential cycles.
Exactly.
So it's taking that big jump as well. I've got time for one more question, which I'm going to take from online, partly because it has a stock tip in it for you, which is, but perhaps you can broaden it out a bit. Have you considered investing in Palantir, because it's a great AI company, but perhaps more generically, how do you go about finding the next Wright brothers, or where is that next innovation coming from, and how as a fund manager do you go about identifying those?
I think there's a couple of ways that you can go about identifying these companies. So I think one of the things is, within Baillie Gifford, we have teams that specialize in sort of small caps and look at these earlier stages. We also obviously have these private market investments, which greatly helps to understand what's potentially coming through into public markets. So getting to know these companies at an earlier stage is one way that we can start to think about how these trends might emerge. I think the other thing is we're very lucky that Baillie Gifford has a very good reputation as being a long-term shareholder in businesses, which gives us very good access to these company management teams, even if those companies are not at the point where they may be investable for us. And that's a really good way as well to get an understanding earlier on about what potential changes might be being driven in the economy going forward.
Very good, excellent. And on that note, I'm going to draw it to a close. The next session in this room is a panel on income investing. But in the meantime, thank you very much, Kirsty. Much appreciated.